Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. 3M has long been known as one of those really safe dividend companies, a dividend aristocrat, if you will. But I think recent operating trends should really call into question whether that's going to be the case long term. Now, a lot of times companies that have paid dividends for a very long period of time will do everything that they can to keep paying that dividend, to keep investor confidence. But that doesn't seem to be working for 3M right now. The stock is down 50% since the beginning of 2018. That trend just continues going lower and lower. Revenue is struggling. Organic growth is basically non-existent. And cash flow is starting to dry up. So I want to dig into exactly what the numbers look like and what we should expect from 3M and its dividend. My name is Travis Hoium. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content. And I want to start with the cash 3M generates from its operations. That's really where everything begins from the standpoint of paying a dividend. You can see here that cash from operations has fluctuated pretty wildly. 3M was actually a big beneficiary when people were buying a lot of PPE or masks. 3M was one of the biggest manufacturers in the world for that. So 2020, 2021 was really a windfall for the company, but that has really reversed course over the last couple of years. So you can see that it's now generating less cash from operations than it was in 2016 and 2017. So that's a really concerning trend. And I think the recent earnings results, which I can put a link to the video that I did in the top right corner, but I just don't see any positives from those earnings results. It seems to be that there's a lot of pressure on sales and margins, and there's no real catalyst in the foreseeable future to turn that around. So that's really where we're starting from. $5 to $6 billion in cash from operations. If we look at free cash flow, about $4 billion, this is the cash that's left over after the company's other obligations like investing in capital expenditures, which is something 3M does a lot of because it does manufacture a lot of its products. So you have to consider that in its cash situation. And then keep in mind that 3M has about $16 billion worth of debt. That is debt that over time will become more expensive as interest rates rise. Now, debt has been coming down, so that's a positive trend. But on a net basis, what does 3M need to generate to keep paying its dividend? Well, it's paying about $3.3 billion per year in a dividend today. On top of that, management has been buying a lot of stock back on the order of billions of dollars over the last 10 years or so. You can see that they were buying that stock back at a much higher stock price than we have today. So another example of management teams often not performing buybacks on a very timely basis. But those buybacks have gone down over time. So the company is obviously saying, hey, we don't have the cash to continue buying back stock. We need to prioritize this dividend. The question long term is whether the dividend is going to be able to grow at all if revenue and earnings are on the decline. And I think the answer is that it won't, but we're probably still 4 or 5 years away before any change in the dividend. But when a company like 3M starts having a dividend yield of 6%, 7%, that should be a warning sign for you as an investor that the market doesn't think that this dividend is going to be sustainable. And I think that's where we're at today. A lot of really high quality companies have dividend yields that are far lower than that because the market thinks that they'll be able to grow those dividends over time. 3M, on the other hand, probably doesn't have the ability to grow its dividend at any sort of significant rate. And that's why we see such a high yield. And that really hampers the company's ability to invest in new things like growth, whether that's organic or through acquisitions. We're actually seeing the opposite with 3M. They're starting to sell off businesses. Now, if that capital is then allocated appropriately to maybe paying down debt or investing in organic growth, that can be a positive for the company. But we have not seen over the last 10 to 15 years that 3M has shown the ability to add value in that kind of way in growing the business organically. And it seems like the one-time benefit from the pandemic, particularly from selling more masks, is now behind us. And now the operating environment gets a lot more challenging. So I don't think this is a company that has a dividend that's in danger today, but that doesn't mean that it won't be in the future. And if the operating trends keep getting worse, as you saw here, the market is just going to keep pushing the stock lower. That dividend will go higher. And instead of seeing that as a positive, investors now at this point need to start seeing that high dividend yield as a warning sign. So what do you think? Is 3M's dividend safe long term? I'd love to hear your comments in the comment section below. Don't forget to follow Rive Investing. Thanks for watching, everybody. See you here next time.